G'day and welcome to What I've Been Reading, the Motley Fool's regular series that brings you inside the work that some of our team have been doing, what they've been reading, what they're thinking about, what they've found interesting. It is, of course, only on our YouTube channel along with a whole lot of other stuff. So a very quick early plug. If you like the video, please hit the like button. Also, make sure you hit subscribe and the notification bell. Why? Because we produce this every week. We do Stocks in Focus, Stock of the Month. We've done a few YouTube lives recently. We do Motley Fool TV. Lots of great content only on this channel. So make sure you do all of those things. And then let's go to Motley Fool analyst Mitch Lawler. Mitch, g'day.
How's it going, Scott?
Mate, very well, thank you. You're going to bring to us a book, I'm going to confess, I've never read. And it's Investing for Growth by Terry Smith. So for me and for our viewers, what is it? Well, I assume the title probably gives it away, but tell us what Investing for Growth is about.
Yeah, well, it's actually a collection of annual letters from Terry Smith and Fundsmith, which is the fund that he has run since 2010, and also a few articles that he wrote over the years for the Financial Times. And so it's really a collection, a distillation of some of his most profound thoughts on investing. And I suppose the title is a bit funny because he mentions Smith's Law, as he dubs it, which is, if an expression wouldn't be used in the opposite, or if it's nonsensical, you wouldn't trust it, you wouldn't use it. And a good example of that is forward guidance. I mean, you wouldn't really, backward guidance doesn't really make sense. So investing for growth is sort of like that, because I don't know too many people who would invest for reduction or shrinkage in their capital. So we should all be investing for growth. But yeah, I suppose there's a lot of really great ideas in this book, and it's one that I come back to quite regularly. Sort of sits on the bookshelf, and I'll flick it open from time to time just to remind myself of some timeless investing lessons. And one of those, and it really encapsulates the whole essence of Terry Smith's investing philosophy, is his 3 steps to heaven, as he calls it, which is invest in good companies, don't overpay, and then do nothing. And I think that last step is one that a lot of us forget from time to time, but it's probably the most important.
Incredible. I love that, mate. Part of that 3-step process where the 3rd step isn't really a step at all, but is really valuable. I say that about the Vanguard chart all the time. I say to people, all you had to do was put 10 grand away for 30 years and do nothing else. But I mean, literally nothing else. Not as in something else you have to do. It's like you have to actually do nothing, precisely nothing. That's a really, really good point. I guess the formula, mate, it's also, I mean, it's broad enough, maybe even vague enough to be hard to, I mean, who's not going to pay too much? Who's not a bit like your point about, are you willingly overpay? No. Are you willingly buy bad companies? No. I mean, maybe someone to do the cigar butt thing, but rather than that, it's every investor's approach, I suppose. What is it about Terry Smith's approach specifically that kind of grabs you?
Yeah, well, the don't overpay, you sort of mentioned, delve into that a little bit. And a lot of people, yeah, it makes sense on the surface. If it looks expensive, don't buy it. Maybe if a company's dirt cheap, 8 times PE ratio, then maybe that's attractive. Maybe that's not overpaying. But Terry Smith really gets into that and unpacks it a little bit further, which is not overpaying doesn't mean that you have to look for companies that look cheap on face value. A low earnings multiple doesn't mean that you're not overpaying for the business. And he provides a number of examples. Colgate, there's a lot of great companies that historically have traded on high earnings multiples. And even if you had invested in those companies at, say, 30 times earnings, you still would have beat the market. And that's really the essence of investing in companies that are good companies that are already earning a higher return on capital than what their cost of capital is. And from the moment that you invest in that business, you're earning value, basically. You're getting more than what you put in.
That's all we're trying to do, of course. Mate, I love that. Just curious, how do you pitch this book? Is it for the novice investor, the long-term investor, the professional, the amateur? Who should read Investing for Growth by Terry Smith?
I think anyone at any experience level could really gain something from this book. There's lessons for beginners in it, and then I think too, I was even flipping through it last night, and it reminded me of something that I'm able to apply in my own investing. A bit of a warning of never forgetting the mistakes of the past, and how as investors we have short-term memories from, well, people in general have short-term memories from time to time of the mistakes of the past. So I really think anyone of any experience level could gain some valuable insights from reading this book.
I'm going to put it on my reading list, mate. As I said, the name actually, Funsmith, rang a bell when you mentioned it. So maybe I kind of heard Terry Smith in the periphery. I've definitely not read the book. So I'm going to put Investing for Growth on my reading list. Mate, thank you for sharing your reading. Thank you for sharing your insights as well. Thanks for watching. Thanks for being part of the Motley Fool YouTube channel. Until we speak again, Fool on.